Hello everyone, yes, Shriram. I hope you're doing good. And I like last time I got a video for stop loss, and this time continuing with the educational series. Now I just made a presentation for why I stopped using indicators. So what is an indicator? It's basically a mathematical formula which we can apply to a chart, and it will represent the it will represent as a diagram or as a means of showing how the market is moving according to that formula. It can be a line or a graph or a bar graph or anything. I myself was using indicators for a very, very long time. And it's been like around a year now that I have completely stopped using it. I was using a combination of RSI and I made my own indicator. I named it cash indicator and I used to use that. But it was a little bit weird because it was working best only at 18 minutes candle. So I was manually checked all the time frames, whichever was available, from 1 minute to 60 minutes. And 18 minutes showed the best result of them all. I was using that. And on an average, I was getting around 1,000 points in Bank Nifty. So I cannot say that it was not working. It was, but the thing is, I was overly reliant on it, and sometimes it just keeps on frustrating, and it made me doubt myself. Okay, because it was not my decision to either enter into a trade or not. It was the indicator's decision, and most of the time I entered at the wrong place because indicators are always lagging. But anyways, let's get into the slideshow, and we'll discuss all the topics one after one. So here's the table of contents. So yeah, I'll talk about personal experiences, the noise and confusion it creates, the limitations of using an indicator, how the market dynamics works, and what I did earlier and what I'm doing now, and how it affected my risk management psychology, and I'll give you a conclusion on it. Okay, so first let me talk about my personal experiences. Whenever I used to trade with indicators, I was overly reliant on it. Okay, because when an indicator works, it's just that it gives you the entry very, very late. Or if there is a huge spike up, then the indicator will never catch up to the market. Just because, let's say, if it's an RSI, the default is 14. You can tweak it, but it's still the data is 14 candles older than what is happening right now. Let's say 100 EMA. 100 simple moving average, let's say take a 100 simple moving average. It's just an average price of the past 100 candles. So the data which it shows is basically 100 candles old. What happens is most of the time, if your time frame is wrong, then the trade which you'll be taking will be wrong. Some people believe that 5 minutes or 15 minutes will work best for intraday, but that's not the case. It doesn't always work that way. And that is what I found out. And this point also covers my limitations. So the limitations is that it just doesn't work on every time frame. You will need to find a time frame which in which it works only for you. So you will have to do a lot of back research and back testing just to find out the exact time frame where you are comfortable taking the trades. And as a scalper, I was not at all comfortable with using 5 minutes or 15 minutes because my trades doesn't last that long. And I didn't like this style of trading where the market already shot up and then the indicator was giving me an entry signal and I had nothing. I just had scraps left for taking, which comes to risk management. Just because my entries were a little bit later, my stop losses would be very, very huge compared to my profits. So that is where I got like really busted open because I was really struggling because some of the times it worked, but I was not, I was waiting for the indicator to give me a signal to get out. And as soon as I did, the indicator would still give me a to enter again. It will give me another trade as well. So the time frame was really, really confusing, and which comes to the point where it's noise and confusion. So in this point, I want to discuss that when you're using a single indicator, it's not reliant and it doesn't work all the time. So you keep on adding additional indicators as well. So let's say if you add an RSI and give an MACD, so maybe sometimes the indicators are not in sync with each other. Okay, or let's say you pair RSI with SMA or Bollinger Bands. Maybe it's on top of the Bollinger Band, which indicates that the market is going for a short. But RSI would have just have crossed 60, so that is still a buy signal. So that is where some of the noise and confusion comes in, and you end up not knowing what to do, or you end up losing the trade. And the worst case scenario, if you lose the trade, then also it's okay. But worst case scenario, what happens is you take the trade and you end up losing money. That is the worst case scenario. And market dynamics keeps on changing. So a single or multiple indicators don't work in every single market condition. So you need to understand that all the indicators are not reliable. And most of the people who are trading with much higher money, they don't use indicators. Okay? Either it's algo trading, maybe that is where some indicators are used, but definitely not the ones you are using. So, and also maybe not even the time frame which you are using. Maybe they are using a 2 minute time frame, or maybe they're using an 8 minute time frame. Who knows? Okay, so they would have backtested their particular indicators for that particular strategy, and they would have got the algos to work for specifically for those conditions only. And maybe they will keep on tweaking and changing the intervals. But if you try to use the same exact indicator for the same exact time frame for all the market conditions, it most probably won't work. So what I was doing earlier, actually I had my own indicator. I named it cash indicator and I was using it. And as I said earlier, it was just working in 18-minute time frame. Then I even looked at market profiles. So I was using that as well. But that also gave me a very, very confusing results. Just because as I went through a lot of videos of how to use that indicators and so on. And yeah, I'll be honest, I even saw some course videos, and those videos they were made to describe the scenarios in one particular case where it worked. Okay, so that is what most of the indicators which are shown to you are designed in a way that, let's say if someone is teaching you how to use an indicator, they will only show you the places where it works. Okay, maybe market move, like let's say 2000 points, market fell 2000 points that day, and if you went to any indicator it would have gone short. Okay, and the worst part is the market opened 1500 points gap down, the indicator would have definitely gone short. No matter what indicator, it would have gone short. There was no way to predict it, and none of the indicators would have predicted the top of that rally where it just shot up around, like I think around 500 points that day when the market gapped down around 1800 points, and then it shot up again and it again fell like around 600 700 points. So none of the indicators would have known where the top would have been. And by the time you enter the shorts, it was already maybe it was already a losing trade because the market was shooting up. When it stepped down, the indicator went short. If you had gone short at that time, the market was shooting up 500 points. Definitely, your indicator would have gone long too. But that too, and then after shooting 500 points, it immediately fell another 700, 800 points. So your indicator would have gone short again, but there was no way to know what the indicator would have been doing. And if you had waited for the confirmation, then definitely you'll end up losing the trade and losing more money. So what do I do now? I just look at the price actions and I look at where there are supports and where there can be resistance. And I just trade the levels. It is much more simpler. I don't use any indicators now. And what happens when I trade like that is I get a better risk management. Why there's a risk management? Why I'm saying this a better risk management? Just because when I when I look at just the levels, okay, I know which level I want to short. Okay, that is what I describe in my everyday video. Okay, every day morning I put a pre-market video, and in that video I just describe the levels from where I want to go short or where there can be a resistance. Okay, if I enter into any trade, I'll be looking to enter exactly at those levels. So what happens is I will already have a game plan, and maybe my stop loss is just 30 or 40 points, which I'm already set. Okay, and if the market goes in my direction, then that is great. If it doesn't, then I know that where I'm stopping. Okay, and in any move, if I'm getting stopped out, then that means the market is. I normally take trades in such places where either the market should go in my direction or it will shoot up in the opposite direction. So my stop loss will be very, very tight. And if in case my stop loss gets hits, then definitely the market is going the opposite way, and the the amount or like the intensity can be much more higher than earlier. Okay, so it's basically if it's a breakout, then if I'm, for example, let's say the market is going long and it reaches a very, very crucial level according to me, then I'll just take shots from that same level. My stop loss, let's say maybe 40 points. If the market breaks my stop loss, then it indicates that the breakout is much, much more stronger than I expected. And let's say I lose 40 points, it's nothing. But the market will at least give me around 100 to 150 points after my breakout. Okay, so I'll have plenty of time to go longs as well. So I'll have a set of game plan already in my mind. So I know when to stop and what to do next. Okay, so I can already plan my trades. But with an indicator, if you're just waiting for it, then you will never be on time to catch a very big move. So that is why I just stopped using it altogether. And how it affects my psychology? Well, as a scalper, I always expect for quick trades. Okay, I expect for a quick 100 to 150 points move or maximum a 200 point move, and then that's it. I'm done for the day. But for my style of trading, I don't usually like to wait for maybe an hour or 2 hour or 3 hour unless and until I'm forced to. Okay, so that is where my psychological effect comes into play. The longer I trade, I have noticed that I start to get headaches and I start taking wrong trades. So I just want to take one or two trades maximum for the day, and that too, I want to enter in a very, very good pace and exit at either the first target or second target. It doesn't matter. If I'm seeing that the market is about to take a resistance, then I'll just stop. or if I'm long and if the market is taking resistance, then I'll definitely book the trade and then done for the day. But sometimes it's like when I'm in the wrong trade, then I'll just wait for my stop loss to get hit. And I have discussed how I set my stop losses in the earlier video. I'll just link it so you can go check that out as well. So that is how, like, once if when I was using indicators, I just kept on waiting, and most of the time I just lost the move, and my stop loss would have been very very far apart, and I was not making good profits. But when I stopped using indicators, that is where everything changed, and I'm much more happier and much more successful than what I was earlier. So in conclusion, this is my story for why I stopped using stop losses. And thank you so much for listening. And as you have come so far, it will be great if you can just like and subscribe to this video. And I'll keep on getting additional educational videos like this. So see you.